Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Stochastic RSI Scalping strategy, a powerful method that combines two popular indicators to enhance your short-term trading decisions. This strategy is designed to help you identify potential entries and exit points. In the fast-paced world of scalping, by the end of this video, you would understand how to implement this strategy effectively, potentially improving your trading results while understanding this strategy. You would cover everything from the basics of the Stochastic RSI to a step-by-step guide on how to use it for scalping. Stay tuned to learn how this strategy could transform your approach to the Forex trading. We start by understanding what the Stochastic RSI is, and the Stochastic RSI is a powerful technical indicator that combines both two popular momentum oscillators. The first oscillator it combines is the relative strength index, the RSI, and the stochastic oscillator. So the combination of these two powerful indicators is what forms our Stochastic RSI indicator. Now let's see how we can incorporate a step-by-step process to a Stochastic RSI scalping strategy. The first step is to set up your chart. You set up your chart, you open your preferred Forex trading platform and set up your currency pair. We'll be using GBP Euro USD for this strategy. You either use your 1 minute time frame or you use your 5 minutes time frame for this strategy. So we'll be making use of our 5 minutes time frame for this strategy. The next thing is to apply your Stochastic RSI indicator with a default setting. You apply it with a default setting of 14, 3 and 3. Your K line should be your 3, your D line should be your 3, your relative strength length should be 14, and your stochastic length should be 14. So this is basically the settings you use for your default. Secondly, you add your EMA, your exponential moving average. You use your 11 period exponential moving average with your 21 period exponential moving average. So these are basically the two indicators you need for this strategy. The second step is to identify the market condition. So before entering a trade, assess the overall market condition. You look for a trending market or a ranging market. The EMA will help you identify short-term trends. It will help you to identify short-term trends direction. To suggest an uptrend, the 11 EMA should be above the 21 EMA. The 11 EMA is this blue line. When this blue line crosses above the 21 EMA, which is this yellow line, it signifies we are in an uptrend, even if it's a short-term uptrend. Conversely, when the 11 EMA crosses below the 21 EMA, like it did in this area, signifies that we are in a downtrend. Now, how do we spot our entries? Step 3. For long trade, you wait for your Stochastic RSI to drop below 20. So once price drops below 20, as we can see in this area, price has dropped, the Stochastic RSI has dropped below 20. We then look for our K line, which is this blue line, to cross above the D line. As we can see, there is a crossover when price is around below the 20. When we notice the crossover, we confirm using our 11 EMA to cross above our 21 EMA. As we can see in this area, price showed us that our 11 EMA have crossed over our 21 EMA. This blue line crossed over our 21 EMA, which is this yellow line. This signifies long position. So we would enter our trade when the current price candle closes. to enter the long trade the moment the current price candle close, which is this, after combining both the K line crossover with the fact that price was trading below the 20 region in the stochastic oscillator, and we notice our crossover between our 11 EMA crossing above our 21 EMA, and at the same time price was trading above our moving average. So these are the confluences that we need to put together to enter a buy trade. This is where we would enter the moment the candle closes above. Now for a short trade, we would first of all wait for the stochastic RSI to raise above 80, and as we can see in this area, the stochastic RSI is above 80. It is above 80. It is currently at 90 region. This signifies an overbought condition. We then look for our K line to cross below our D line, and if you can look at this area, we would notice that this blue line crossed below our D line. The blue line crossed below our yellow line, signifying the K crossing below the D. Then you confirm from your chart, you confirm that the 11 EMA crosses below the 21 EMA, which happened here. This blue line crossed below the yellow line. This signals our selling opportunity. At this area, you will enter your trade the moment the current candle closes. This is where you want to enter your trade. Then where do we place our stop loss? Immediately after entering the trade, you set your stop loss. For a short position, you set your stop loss 5 to 10 pips away from your entry. 5 to 10 pips away from your entry. So I will set it at 10 pips away from my entry. This is 10 pips. For a buy position, you set it 10 pips below your entry. So setting it at 10 pips below our entry. This is how you set your stop loss since we are scalping. Then for your take profit, you use a fixed risk to reward of at least 1:1.5. You use a risk to reward of 1:1.5. This could be your minimum risk to reward ratio, or you can go for 1:2 as the case may be. Anyone you feel comfortable using should be what you would make use of. 1:1.1:1, 1:2, or 1:1.5. Remember to always manage your trade by monitoring open positions closely. If the trade moves in your favor, consider moving your stop loss to break even once you have achieved a certain amount in profits. This protects your capital when allowing the trade room to develop. Be prepared to exit the trade if the stochastic RSI signals a potential reversal. How does it signal a potential reversal? When it gets back to the overbought region in a buy trade. In a sold trade, when price gets back to an oversold region, if you are monitoring your trade, you exit your trade at that area, or you exit your trade when you see another crossover. You always have to analyze. The subset is to always analyze and refine your entries. After closing a trade, whether it is a win or a loss, take your time to analyze it. Look at what works well and what could be improved upon. Consider factors such as market volatility, news events, or other patterns you notice. Use this information to refine your strategy over time. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.